Should investors buy the dip in Rivian automotive stock? After the company reported disappointed earnings, the stock is down dramatically. I'm going to answer that question if you should buy Rivian stock on the dip. I'm also going to do a review of Rivian's earnings results in this video. So, if you have been following my channel, I released a video a month ago saying 4 stocks you should avoid in February. Rivian was included in one of those 4 stocks, right? So the others were Lucid, Fubo TV, and Skills. And here's the results of how these 4 stocks performed in February. Rivian has been down 19.2%. Skills is down 25.69%, Fubo down 27%, and Lucid down 27%. So this is in the last month ending as of right now. I'm recording this video on March 1st. So from February until now, 1 month trailing. These are the results of those 4 stocks that I recommended you all avoid. So I hope I have saved you all some money from investing in those stocks, right? So now let me get into Rivian's earnings results. So revenue surged to 663 million in Q4. This was up from just 54 million in the same quarter last year. Of course, Rivian is just recently starting to ramp up production, and it's growing from a small base, and it's growing quickly. However, the company is losing a lot of money on the bottom line. On the net loss decreased to 1.72 billion. This was an improvement from a net loss of 2.46 billion in the same quarter the prior year. Rivian increased production by 36% from the previous quarter. So that's a significant increase in terms of quarter-over-quarter production. The company is forecasting a production target for 2023 of 50,000 units. This would be nearly double this year's production, but it was less than what Wall Street was looking for. Wall Street was expecting an announcement of somewhere between 60 and 65,000 units for 2023. For now, it seems like production is the main headwind for Rivian. There seems to be enough customer demand for now to fulfill all of the cars that Rivian can produce, but I don't know how much longer that's going to be the case. Right now, customer orders for EVs still remain high, but as prices are going up, as inflation is going up, and consumer budgets are getting pinched and layoffs are increasing, customers might start to say, do I really want this expensive electric vehicle when I could have a lower priced ICE, internal combustion engine car? So that might start to be a headwind. And that could partly explain why Rivian removed its pre-order numbers. Those numbers had started to come down, and Rivian noticed that those pre-orders were coming down. So it just said, you know what, we don't want to report that number anymore. It doesn't make us look good, so we don't want to show that, right? Oh, thank you for that timing, right? When the numbers were good and they were in your favor, you were highlighting those pre-orders. And when the numbers started coming down, management told us we don't want to show you those numbers anymore. I don't like to invest in companies that play those kinds of games. That's partly why I had recommended Rivian as a stock to be avoided in the last month, and I've been bearish on Rivian for quite some time now. And these are some of the reasons why. That wasn't the only reason, but that certainly had a part to play. I like to see more transparency from management, not less transparency. So anytime I see transparency being removed, that's a automatic red flag in my mind. The company does have $12 billion in cash as of December 31st, so it's got enough money to ramp up production at least for 2023. In 2024, we can start to speculate as to if it needs to raise more cash or where it's at. We'll know more as this year progresses. The company's forecasting positive gross profit in fiscal year 2024. That was really good news. Losses will continue in 2023, and the company will still be losing money on the bottom line in 2024. Gross profit is just the first level of profitability. After gross profit, you have operating profit, and then after operating profit, then you have net profit. So Rivian is just going to get to the first level of profitability, gross profit, in 2024, and even that's not a certainty. The cost of goods sold is pressured by premium prices for materials, and I've been talking about this for several months now as well. Several car companies have now begun to ramp up production of electric vehicles. It's not just Rivian, Tesla, Lucid, NIO, BYD, Ford, GM, Honda, and others. So many car companies are now saying, okay, EVs, customers want them, we're going to make them. And so now that all these car companies are battling for the same materials that go into EVs, that's bidding up the prices for these materials. So all of these car companies are now going to have to pay higher prices for those materials. That's going to pressure margins for the entire industry. I don't like to be investing in an industry that's experiencing this kind of fierce competition. Competition can be not just on the sales side, but it can be on the supply side as well. And that's where the EV industry is facing the most significant competition, is on the supply side, not so much on the sales side for now. Cash flow from operations in Q4 of negative 1.45 billion, plus the company had to spend 294 million in capex, so about 1.8 billion in negative free cash flow here in the fourth quarter. And if you look at, it's got 12 billion in cash as of December 31. It can continue at that pace for at least 4 more quarters, and that would still leave it with a couple of $1 billion in cash to continue ramping up production. And this is not just the case for Rivian, but competitors also. Capitalization for these EV companies soared during the pandemic because these companies were so popular. They were able to raise billions of dollars in capital during the earlier stages of the pandemic, 2020, 2021. They got billions of dollars from investors, and so they could continue burning through these billions of dollars for several years, losing money industry wide, before any of them says, okay, you know what, I don't think we're going to be able to survive in this industry. So there isn't going to be, you're not going to hear very many announcements of EV companies saying, okay, we're out, we can't compete in this industry, it's too tough. And that could have been one tailwind that could possibly improve profitability for the industry, but since so many of the competitors are so well capitalized, there's going to be few of them backing out. So that's another headwind. So to answer the question, should investors buy the dip in Rivian stock? The answer is, I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. The answer is no. The answer is no. The company's got a long way to go until it reaches even the first level of profitability. And sure, it's got potential, but I want to see more proof before I would commit to buying Rivian stock. There's plenty of other companies in the world today that have excellent potential and deliver excellent profits that you can buy right now. So you don't have to go with one like Rivian that's mostly trading on potential and has little to show of profit prospects or improvement in economies and scale and showing profitability. So I would say stay away, keep staying away from Rivian stock for now. As usual, I will update you every quarter when there's new announcement. As the company makes progress, I will update this recommendation. All right, thank you for watching. If you enjoyed this video, I'm going to link 2 videos at the end of this one that I think you will also enjoy. So please go ahead and click on those. I will appreciate it, and I will see you over there.